Hey everyone, welcome back to our channel. Today we're going to dive into a topic that might sound a bit daunting, but is super important: tax audits. Don't worry, we'll break it down into easy to understand pieces. So, let's start from the basics and work our way up. Before we get into tax audits specifically, let's talk about what an audit actually is. Think of an audit as a detailed checkup on an organization's financial records. Just like a doctor checks your health, an audit checks the health of your financial records. It's an official review to make sure everything is in order and accurate. This can be done by an independent body to ensure it's impartial. So, what's a tax audit? Well, a tax audit is a special type of audit. It's specifically about checking your financial records from a tax perspective. It helps make sure that all the income you report and deductions you claim are correct. The goal is to ensure you're paying the right amount of tax and following all the tax laws. Sounds crucial, right? Now, why do we need tax audits? Here are the main goals. Check accuracy. Make sure that the books of accounts are well kept and accurate. This is certified by a chartered accountant, also known as the tax auditor. Spot issues. Identify any discrepancies or mistakes in your financial records. This helps in fixing errors before they become bigger problems. Report key info. Provide important details like tax depreciation and compliance with various tax rules. This helps tax authorities verify that your tax return is correct. Let's talk numbers. When do you need a tax audit? For businesses, if your total sales, turnover, or gross receipts exceed 1 crore rupees in a financial year, you need an audit. For professionals, the limit is 50 lakh rupees. But there's an update here. According to the Finance Act 2021, if cash transactions are less than 5% of your total transactions, the threshold for businesses goes up to 10 crore rupees. Here's a quick guide to when you need a tax audit. Business. If your turnover is above 1 crore rupees or 10 crore rupees with minimal cash transactions, you're set. There are also specific rules if you're using certain tax schemes. Profession. If your gross receipts are above 50 lakh rupees, you need an audit. If you're using a presumptive tax scheme, additional rules apply. And remember, even if you're showing a loss, you might still need an audit if your turnover exceeds 1 crore rupees. Let's talk about what goes into the audit report. The auditor will use different forms based on your situation. Form 3CA for those already audited under another law, Form 3CB for those not audited under other laws, Form 3CE for non-residents and foreign companies receiving royalties or fees for technical services. In addition, Form 3CD is used to provide detailed information and observations from the audit. The Taxation Audit Form 3CD is a comprehensive statement covering a group of particulars that present 41 clauses. These terms are based on the business and its transactions, such as turnover, revenues, and details regarding asset liabilities, profits, and expenses. The taxpayer must include all of these crucial aspects. The individual performing the audit needs to submit the specific findings included in the report with the help of the applicable audit form. The type of form one needs for the audit will be mentioned by the Department of Income Tax. Section 44. AB demands the forms 3CA and 3CB. The auditor needs to furnish the form and the forms mentioned above. Form 3CD applies when an individual's financial data does not require any audit under other legal regulations besides income tax law. Also, Form 3CD particulars need to be furnished as per Rule 6G, along with the forms 3CA and 3CB as required. The 41 clauses mentioned in this form are divided into 2 sections: specific disclosures related to deductions, TDS, loans, and more. In the final part, the form explicitly mentions the auditor's address, name, signature, membership number, and FRN number with a seal stamp. When do you need to get this all done? For the financial year 2023 to 2024, the deadline for completing the tax audit is September 30th, 2024. But if your accounts are subject to transfer pricing regulations, it's October 31st, 2024. Don't miss these deadlines to avoid penalties. So how do you file the audit report? The tax auditor submits the report online using their chartered accountant login. You, as the taxpayer, will need to review and accept or reject the report in your online portal. Remember, the final date for filing the tax audit report is October 31st for international transactions and September 30th for others. The big takeaways from an income tax audit are: check records, ensure your accounts are maintained correctly without fraud; report issues, identify and report any discrepancies; simplify computation, helps in calculating taxes and verifying deductions; verify returns, confirm that the income, tax and deductions reported are accurate. Finally, let's discuss penalties. If you're required to have a tax audit and don't do it, you might face a penalty. It could be 0.5% of your total sales, turnover or gross receipts, or 1,50,000 rupees, whichever is lower. But if you have a reasonable cause for the delay, like natural calamities or loss of accounts, you might avoid penalties. Always keep documentation of such reasons. And that's a wrap on tax audits under Section 44AB. I hope this breakdown makes the concept clear and manageable for you. If you found this video helpful, give it a thumbs up, subscribe for more tips, and drop any questions in the comments. Thanks for watching, and see you next time.